this is a continuation of the materials that I've posted, which relate to ethics and what I've described as being international dilemmas. But they're all ethical dilemmas, I think. They're ethical and moral dilemmas, because what they're doing is that they are drawing attentions to what is right and what is wrong within our international business and our economies. And one of the attempts to try and correct the perceived rights and wrongs relate to a growing focus on ESG frameworks, which is environmental, sustainable, or social, or governance frameworks. And you can look at different ones as well, like CSR, corporate social responsibility, and so on and so forth. And all of these really draw attention to and start to question what's the point of the profit-making firm. And I addressed that in earlier material, so I'm not going to go through that again, because you can refer back to that. But it's starting to introduce a wider discussion or focus upon a tension that exists between shareholder capitalism and stakeholder capitalism. In our financialized era, we might argue that the focus has been traditionally on shareholders, but now there is wider appreciation that the firm needs to attract or appeal to or serve a wider group of stakeholders. And I think we've addressed those in the past as well. So they would be things like customers, workers, the environment, or at least the external environment to wherever things are being produced, which would include local people to it, and to the production plant or to the office plant, and so on and so forth. And governments as well, because governments have a stake in any business because they're recipients of tax. And we've talked over the weeks about how those links between the firm and other stakeholders have either deteriorated or broken down. And this focus or refocus on ESG frameworks has brought the focus of the firms back into perspective. The argument being, and stakeholder capitalism is not a new argument, it existed in the 1930s. And the argument being is that the firm can be profitable and it can serve a wider constituent of stakeholders. Now, I think that is challenging because there's only an X amount of free cash flow that's available. And that cash flow can go in different directions. The firm can either save it as being an asset, it can pay it to its workers, it can pay its profits to its shareholders, or it can pay down its debt. Really, it hasn't any other choices as to what it's going to do there. And so, the very sort of like theoretical or practical foundations of ESG frameworks are challenging, because will a firm spend money on an ESG framework or corporate social responsibility, which is going to detrimentally impact its bottom line, or is going to affect its ability to pay dividends to shareholders? So we just need to hold that in mind as we go through these. And recently, the United Nations have created a perspective which is about a launch of sustainable development goals, 17 goals to transform our world. So the United Nations recognized that a wider focus beyond just the purely economic was required, and developed these sustainable goals. And to that end is that firms have created this roundtable where they've signed up to the United Nations Responsibility Framework and have created a series of objectives which widen the scope of the firm in terms of its stakeholder or serving stakeholders, as opposed to just serving the stockholders. And there are about 161 of these that were signed up to them. Some of them are the big banks and the big tech corporations that we've been looking at over the last few weeks. And as a consequence of that is that has led to an appeal, or a wider appeal, and a growth in responsible investment. In that, if you look at the blue chart, or the blue axis on the right hand side of the graph, is that the number of firms, practices, financial intermediaries that are now offering green financing or ESG financing opportunities is now over 1,500 different firms across the globe that are offering specific financing for green purposes. And we could trace that, or the popularity of the rise of ESG financing, through a number of different narratives that have been generated and have created the market. Remembering that narratives perform the market. As more and more people have talked about the importance of ESG frameworks, more financing has become associated, or has wanted to become associated with that direction. And so we've got this kind of critique of shareholder capitalism, an emergence or a re-emergence of stakeholder capitalism. And as a consequence of that, you get signatories of firms into stakeholder capitalism and widening their own appeal to different stakeholders and being more responsible as businesses. And then you get the financial industry that therefore starts to support those kinds of initiatives. Okay. Now, this to me, and I'll come on to this again as we go through it, this to me is an interesting sort of phenomenon, because I'm interested in the direction of causality. What causes what here? Is it, and I've presented it as a particular narrative, but is it the green financing that produces green companies, or does green corporate aspirations produce the green financing? And I think that sits at the core of the Apple bonds sort of paper, which we'll come on to in a minute. And ESG investing equates to approximately 40% of global GDP. There's a lot of money. 40% of global GDP will be somewhere in the region of around about $42 trillion. And my question is that what's the output? Where are the outputs? To the best of my knowledge, is that in terms of environmental sustainability, is that we still have a very big issue with global warming and climate change and pollution and so on and so forth. And yet there is $40 trillion plus that is invested in the financing of ESG activities. The majority of it is in Europe and in the United States. And the United States is probably the biggest culprit in terms of rejecting environmental issues. Now, ESG financing doesn't just go into the green industry, but the green element, but it is an important element of it. But the point I want you to take from this is the amount of money that's invested in ESG frameworks is huge, but what's it delivering? And this again comes back to the article, in that, are we looking at investing for a purpose? Who are the beneficiaries of the investments? Or are the investments actually just because people want to drive yields? Are we investing in green industries because the yields are higher in green industries than in other industries, or in green corporations because they're higher there than they are in other sectors which are slower to grow? So that's a question that needs to be considered here. And if you look at the Global Sustainability Alliance, which produces a report into global sustainability funding, is that the three big sponsors of that organization are all investment banks or investment corporations. They're financial intermediaries. And within their report is that they say that their job is to manage the capital, i.e. they don't want capital to be destroyed. So they're happy to invest in green investments, but they still want their yields. So I looked a little bit deeper into the sustainability index, and I thought we'd address water, okay? Because there is a Dow Jones Water Index, which is one of the indexes people can invest in. Comprises 29 stocks of firms that are involved in the water business, and water utilities are generally part of a stable and much less volatile sector. So they have an appeal to the investors because it lacks volatility. Another major benefit of water utilities is their abundant dividends. Now, all sorts of questions can be asked about why water companies are actually to be able to generate huge amounts of dividends that they can return back to their stockholders. There's elements there about the legitimacy of their business models, about price gouging, and so on and so forth. But whichever way you look at it, is that the stock prices of water utility firms are growing. Now, we know, don't we, because we've talked about this in the past, is that narratives create high yields from things like the bricks. Well, here you've got index financing into green financing, but it's basically into the Dow Jones Water Index, which means that those that are investing in the water index are investing in the stock prices or the shares of those various companies. And because nothing new is produced when you just invest in a stock price, is that the stock price will inevitably go up. So those members that are contained in those 29 members that are contained in the Dow Jones Water Index, if sufficient people invest in the index, their stock price will go up, irrespective of what they do. And the appeal is one of lack of volatility and high dividends. And yet, millions of Americans can't afford to pay their water bills. In the richest country on the planet, millions can't afford their water bills, as the price of water has risen 80% in a decade, which is interesting because actually the production of water shouldn't be really any more expensive, should it? It falls from the sky, broadly speaking. And what you do, therefore, is you collect it and then you put it back into people's pipes, and they have access to it. But 1 in 3 people don't have access to safe water supply on a global basis. And there are still huge parts of the global population that are reliant upon traveling to the water source in order to collect water, and that might not necessarily be safe. And yet this is something that we depend upon on our lives. 40% of GDP invested in green financing or ESG financing, and yet 1 out of 3 people in the world don't have access to water supply. What exactly is the money being invested in? But actually a demonstration of the fact that you're not subscribing to ESG frameworks can have a detrimental impact upon your own share price. ESG controversies have wiped $500 billion off the value of US companies. And we've given the example of Google there. And Google's was one of governance that really hit its share price, in that the shareholders of Google suggested that Google needed to make changes to its board. Its board was male, pale, and stale, and they suggested they needed to widen the gender quotient and also the ethnicity of members it needed to create a more diverse governing framework, which Google as a corporation rejected out of hand and suffered a shock or a hit to its share price. And so falling foul of ESG expectations can have an impact upon share price. There's no doubt about that. And what they do is that the way that the indexes decide whether or not a firm is a green firm or an ESG firm is that it does what's known as norms-based screening with the Sustainable Investment Goals of the United Nations, the responsible goals. So basically it checks the corporation's literature as to whether or not it adopts the norms that have been set out in the responsibility investment. So it looks at stories and so on and so forth as to whether or not the firm is actually complying with the requirements of ESG frameworks. So I did a little bit of work on this, and I looked at the 5 largest grossing firms that are listed on the S&P 500, highest revenues, and 3 of them, of which are signatories to the Business Roundtable, which is Walmart, Exxon, and Apple, interestingly. But when you start to look at what they actually do in terms of their CSR spend or their ESG spend, is that all of them produce a glossy report every year, which establishes their ESG credentials, which is how they pass the norms-based screening and be recognized as being an ESG corporation. If you consider Walmart as an example, Walmart have spent $27 million a year over the last 5 years on CSR or ESG frameworks, which is a lot of money, and I'll give them that. That's great, but it's only 0.005% of their actual total revenues. So it's minuscule in comparison to their revenues. And they paid their chief executive $24 million last year anyway. So they pay their chief executive almost as much as that they invest in the CSR frameworks. And if you therefore go to the sort of like the gold table that's at the bottom half of the slide, and you look across to the second column, which is stock buybacks, is that between 2017 and 2019, is that Walmart have bought about 16, 21, 22, $22.5 billion of their own stock back, which benefits the stockholders, which of course the biggest stockholders in Walmart is the Walton family. So on that basis about where spending is made and where spending goes, is that we could raise questions about the legitimacy, therefore, of the ESG credentials of these particular businesses. Are they just creating a narrative which bridges the gap between expectations and realities so that they can benefit from ESG financing? Now, we don't know that, but we can infer on the basis of the data that's put in front of us. If we look at big tech and Apple, is that I've looked through all of Apple's ESG reports. They're freely available online, and I challenge you to do exactly the same. And I've tried to find out how much money Apple has spent on its ESG frameworks, and effectively it's zero. Now, that needs to be qualified because they have invested in a completely new manufacturing plant, which is powered completely by renewable energy. And that's a great thing, but they didn't close the old one down. It's so they've only built a new one because they've got the requirement for increased capacity, or they need increased production. So in effect, their global carbon footprint has gone up. So you can tout the one or advocate the one, but you need to take into account the packages in its entirety. And it classes things like training its own staff in ESG as part of its ESG responsibilities. And there are questions to be raised there about the legitimacy of good housekeeping and good management as to whether or not we're subscribing towards ESG. And is this what is meant, therefore, by firms being environmental, social, and responsible? Is that we just train the people that work within and we demonstrate good practical management? And this is the way in which people will win, but also the firm will win. And questions, therefore, is that sufficient? So Apple, in effect, spend very little on ESG spending, but in the year that I looked at them, which was 2017 through to 19, is that Apple had spent somewhere in the region of about, set up those numbers, 110, 140, 150, 156, 158 billion dollars on buying back its own shares. So where's its real focus? Again, interpretations can be made about that. But if actually it spends very little on its ESG framework, but $130 billion on buying back its own stocks, it doesn't look to me, on balance of the evidence, that Apple is a environmentally focused firm, but is a shareholder firm, a shareholder return or shareholder maximization firm. And so we're questioning all sorts of things about causality here. What causes what? Is Apple creating a narrative that bridges expectations, positions it as an environmental firm, which allows it to enjoy environmental financing, which drives its share price even higher? Or does the financing drive the activities of the firm? And there are question marks about that. And COVID, as in essence, has just accelerated the debates, hasn't it? You know, it's exposed the fractures in our environmental, in our business and our sorry, coughing attack. I'll clip out the coughing attack when I actually post the video. Nobody wants to hear that, do they? So I apologise for that. The question that I was posing there was that COVID has exposed the fragilities and the fractures within our business and economic system, and these have gained new momentum. But it remains to be seen as whether business as usual means that we focus upon the shareholder maximisation, or whether or not there is a readjustment and a legitimisation of stakeholder capitalism. But because cash flow can only go in so many directions, I'm not sure as to whether or not our current economic system and our business, the way that business is organised and structured, as to whether or not in the long term, without significant change, is that momentum will be maintained.